How difficult is it navigating the ambiguity, not just of markets, but where the macroeconomy is really headed?
Look, it's incredibly difficult at this point because not many of us have ever seen high inflation, rampant inflation, and then this sharp increase in interest rate expectation. At the same time, the economy, most of the economy is still recovering from the pandemic and the lockdown and things. So there's a lot of moving parts at this point, and then the share market is trying to deal with it as share market always look forward 12 months.
What are your favourite trades right now then?
Yeah, look, I think what's interesting is that if we look at where the share market is, the Australian market is at forward 18 times earnings, which is pretty much on average in terms of the earnings multiple. So the market is reasonably priced. And then over the next 12 months, we just talked about all these uncertainties. But what we do know is that corporate earnings growth will slow, and then we know the interest rate will go up, but we don't know how far, but it will go up. So all that combined, it does mean that overall index level, we only have marginal gains in the next 12 months.
What was really interesting here in the U.S., Jun Bei, is that we are now seeing already the busiest month in a few months already when it comes to M&As. $13.4 billion of tech-related M&As here in the U.S. With a more challenging environment and with companies having a hard time really finding growth, could we see more of this across the world as well?
That's a really good question because, as you mentioned, the corporates are sitting on very strong balance sheets. So as the growth slows down, that's a natural area to allocate. And aside from the corporates, we do have the private equities and other unlisted vehicles that are sitting on a lot of cash and waiting to be deployed. If anything, on the Australian market, we just saw another M&A bid for a small tech company, and then in the last few months, we've seen quite a lot of it. This is one thing that will underpin the positive area of the share market in the next few months, just as the market is sort of still revaluing some of those sectors that's been sold off a bit too aggressive in the last 6 months.
Jun Bei, I mean, I keep hearing the bear market rallies look very similar to the start of new bull market rallies. So how do you differentiate where we are in the process, and what are some of the signs that you're watching out for?
Look, honestly, I don't believe this is a bear market rally. We do think the market on the overall index level looks reasonably valued. However, even though we're talking about the corporate growth slowing and the like, they are still growing. And some of the growth, if we look at the Australia, for example, some of the corporate growth still above the trend compared to the previous decade. So it is not too bad. Then we've got big dividend coming through. We've got, and then we've got the inflation potentially peaking out. So all of that is a positive note. So for me, is that I think the share market will do okay. It's just the return expectations, perhaps somewhere in the low single digit to mid single digit, instead of the it's about to crater. And we just talked about the M&A. All of these will underpin the support for the share market.
And we have seen interesting moves with the Aussie dollar strength, given the widening yield differentials with the U.S. and the U.S. dollar as well. Given that yes, they're both hiking and tightening, but the Fed perhaps not as fast as the RBA. How do you play these interest rate differentials across the world?
Look, the interest rate differential will continue to narrow over time because Australia perhaps is just on a slower path compared to the US, and we do have to tighten quite quickly, I guess, to really suppress some of the inflation that's coming through, whereas the US perhaps the expectations there. But net, I think all of us will see interest rate increase, and the inflation. We just keep fingers crossed that over the next few readings will start to top out, but we have to wait and see.
When you take a look at structural growth opportunities, which stocks are you liking? I know that you're still pretty bullish on healthcare.
Oh, absolutely. I think when we talk about all these uncertainties out there for the share market and for a share market that's sort of more neutral valued, healthcare is a standout place because their growth is not underpinned by economic activity and the like, and they have their structural growth levers, and it's fantastic as part of the portfolio. And if anything, a lot of them have been sold off during that whole growth sell-off period. period. So they provide very good underpinning. At the same time, some of the other sort of tech leaders, it's time to look at them as well, because they do provide that structural growth. Because if we look forward next 5 years, the growth will be slow, be a little bit tough, and so you do want those companies to grow your portfolio. Cyclicals are looking a little bit tough, but we do think China, perhaps at some point when it comes out of lockdown, the stimulus will eventually to fuel some of the commodity areas as well.
Jun Bei, let me ask you an all-encompassing, very broad question. It's our MLive Pulse question of the week. Is recession necessary to rein in inflation?
Look, I don't think that recession is necessary to do so, simply because some of the commodity areas and some of the bottlenecks for the supply chain is already coming through. We just need a period of absorbing and also allowing some of those mechanisms to work its way through. And in a way, it's perhaps good that China is slowing coming back into its full capacity for its economy, so that our supply chain pressure is not as bad as it could be. So yeah, net we think it's potentially we could maneuver that, but we do have to wait and see what the inflation readings will be.